Welcome, good people. We want to tackle a question from the August 2021 paper. August 2021 paper, and this is ATD Level 1, Introduction to Financial Accounting. Introduction to Financial Accounting paper. ATD Level 1, August 2021. This is question 1. We'll start with question 1 and then proceed in our subsequent videos with the other questions. So question 1A, citing an example, in each case explain the following terms: prepayment and then accrual. Come back to that. And then we have part B, which basically requires us to come up with the relevant ledger accounts, and then we're supposed to close them as at 31st January 2021, and then extract a trial balance as at that date. So we will go straight to the question and try to tackle it. So, citing an example, in each case, explain the following terms: prepayment. Explain the following terms. A prepayment is just a payment in advance of its time. Payment done or made in advance of its time. So you pay before the due date. You can pay before the due date, before the period that you are paying for is actually, before we get to the period that you are paying for, then we say that you have paid in advance, and we call that a prepayment. So payment made in advance of its time, we call that a prepayment, and it's normally treated as a current asset. It's a current asset in the books of the books that show the position of the business as at any given point in time. So it's treated as a current asset because that is money that belongs, it still belongs to the business, though it has been paid. The reason why it's still counted as the business money is because it has not been utilized, because the time has not yet come for it to be utilized. So it's just like money that is somewhere waiting for its correct time to be used up. So it's treated as a current asset. Normally we call them prepayments. So a very good example of a prepayment is if you pay an expense for next year. For example, if I pay insurance expenses for half of next year. So this half of the following year will be treated as the advance payment, and that's what we call prepayment. So if I pay for next year, that will not be a payment. It's not actually a cost that has been incurred in this financial period, but it's a payment that we have made in respect to the following year. So we paid for the following year, but this year. That's what we call prepayment. You pay in advance of its time. The real time is next year, but we have paid before we come to the real time or the exact period in which it's supposed to be paid. Then we have accrual. An accrual is just an outstanding. An outstanding is an amount that has not been paid. That has not been paid in its due time. An amount that has not been paid in its due time. So it's outstanding. It's supposed to have been paid, but it has not yet been paid. For example, if we have outstanding expenses for last year, outstanding expenses for the preceding year, outstanding expenses for the preceding year. So we were supposed to have paid, say, wages and salaries for last year, but we have not yet paid up to today. And this is a totally different financial period from last year's financial period. So we say anything that is outstanding has not yet been paid, and we move to another financial period, then we talk of an accrued. It can be an accrued expense. It can also be talking about an accrued income. So all can be either way, accrued expense, accrued income, but the bottom line is that an accrual is something that is outstanding. It has not been paid in its due time, and so it has gone over to the next financial period. So if it's an outstanding debt, if it's an outstanding expense that has not been met in its due time, we call that an accrued expense. If it's an income that we were supposed to receive, say last year, and we have not received, we call that an accrued income. It was for last year, but we've not received. We've gone to another financial period, and we have not yet received what was supposed to be received in the last preceding financial period. We call that an accrual or accrued expense or income. So prepayment, payment in advance, accrued or accrual is an outstanding payment or receipt. Accrual, an outstanding payment or receipt. A prepayment is a payment or a receipt in advance. It can be a payment or a receipt in advance. That will be the summary for this. So payment, a prepayment we've said is can be a payment or a receipt in advance. So we've just added the word receipt, payment or a receipt in advance, and then an accrual is a payment or a receipt that is outstanding. Payment or a receipt that is outstanding. So that should be able to give you the 2 marks. Just explain what prepayment is, what accrual is, and then give examples. Let's go to the second part. Cecilia Atieno lost her job after her employer closed shop due to effects of COVID-19 pandemic. With her savings amounting to 950,000, she started a general supply shop in January 2021. Her transactions for the month were as follows. Started business with 950,000 in cash, bought goods on credit from John C. Traders, credit sales, then purchased goods in cash, bought second-hand motor van, paid motor expenses, credit sales, then purchased goods on credit, purchases returned to Jolsi, sales returns from Swaju, cash drawings by the proprietor, payment made to Devins C. Limited, received payment from BD Limited, received payment from Swan Limited, purchases returned to Jolsi, purchased stationery, 4,000 paying by cash, and then lastly credit sales. So you are supposed to come up with the relevant ledger accounts and close them as of January 31st, 2021, 12 marks, and then extract a total balance as at that date. So we'll start right away. We'll start with this first part. Cecilia Atieno lost her job after her employer closed shop due to effects of COVID-19 pandemic. With her savings amounting to 950, she started a general supply shop in January 2021. Her transactions for the month were as follows. So January 1st, she started business with 950,000 in cash. So that is the first transaction that we're going to have. So we simply come here. We are going to open ledger accounts. So ledger accounts. So we come here, open the first ledger account. So like that. This will be, let's call this capital account. Capital account. So capital account will have both credit and debit. And then we'll also open another account here, which we are going to call the cash account, which will also have the credit side and the debit side. So this is January 1st, started business with 950,000 in cash. So 950,000 in cash. Remember, the rule is very simple. I'll go to the rule. Assets we debit the increase, and then credit the decrease. If assets are decreasing, we credit. Then liabilities, we credit increase, and then we debit decrease. If liabilities are decreasing, we credit. Then for expenses and losses, we debit. For incomes and gains, we credit, and basically that's the rules. Those are the rules that are going to help us. So let's pick our what we are required to do is just to identify if it's an asset, a credit, where it belongs. That is all. So started business with 950,000 in cash. Cash is an asset, so it's an increase in cash. So an increase in cash, we simply debit. So we say January 1st, we say capital account. We normally mention the other account that has affected this account. And then we say for cash, this is now capital is a liability to the business. This is money that belongs to the owner of the business, has pumped into the business. So we'll come here and say January 1st, cash account. That is the account which has affected this, and the amount is 950,000, like that. So you can see it's a debit and credit, and that is what the duality concept is all about. So then, bought goods on credit from John C. Traders at 180,000. Bought goods on credit from John C. Traders at 180,000. So when we buy goods, the account that comes into play here is the purchases account. Purchases account. So we are going to open a purchase account like that. All these purchases account, credit, debit, and we're also going to open the John C. account. John C. account. So we'll come here and open this John C. account. So John C. account. Why are we opening this account? Because she's now a creditor, and creditors, it's preferable that we open individualized or personalized accounts. So bought goods on credit from John C. Traders, 180,000. This is on January 2nd. And because these are purchases, goods are coming into the business. So we talk of January 2nd, John C. Traders. How much? 180,000. So we always assume debt, then the particulars, and then the amount. Then this side under John C. Traders, we'll also have January 2nd, because John C. is a creditor, credit is a liability. So we come here and say purchases. How much? Purchases 180,000. So you can see we have debit and credit. Debit and credit. Then we go to the third item. Credit sales. BD Limited 66,000. Then we also sold. Credit sales, it means we sold on credit. So BD Limited 66, Swaju Investment 25, and Swan Limited 43. So credit sales, will come here and open the credit account. We'll come here, open the credit account like that. So make sure you leave enough space that we'll be able to. So this is a sales account. So credit and debit, and then we now come back here to get the particulars. This is January 3rd. Credit sales to BD Limited 66,000. So we come here. Sales is a credit account because goods are leaving the organization. So January 3rd, BD Limited 66,000. And then you come here and open an account for BD Limited. BD Limited account, credit and debit, and then we say, now this is a debtor. A debtor will be on the debit side because a debtor is an asset to the business. So we say sales account, how much? 66,000. So we always write the account that affects this or that is affected by that. So this is the first part. Then we have Swaju Limited 25,000. It means we sold again to Swaju Limited on the same date. So January 3rd again, Swaju Limited. How much? Let me just confirm the figure again. The figure is 25,000. So we'll come here and do the 25,000. So Swaju Limited 25,000, like that. Then we come here, we open another account now for Swaju Limited. Swaju Limited. All these are debtors, and so we have to make sure we have to open personalized accounts for them. So because these also are data, we'll simply come here and say Swaju account. Sales is the account that is affecting it, and the amount in question is 25,000, like that. Then you go back to the question, credit sales to Swan Limited 43,000. So we'll come here again and say January 3rd, all these are sales. Swan Limited, how much? 43,000. So we come here and say Swan Limited. Make sure you leave enough space. Swan Limited, 43,000, sorry. So January 3rd, sales account 43,000, like that. So then we go to the next item, purchase goods in cash to 30,000. Purchased goods in cash. So if you purchase goods in cash, that will be a debit entry. The purchases will be debited, cash will reduce. So cash reducing, we go to the cash account. The two accounts that will be affected are actually purchases and cash. Purchase goods in cash worth 230,000, and the date is 4th. So January 4th, we say cash account. Sorry, I'm forgetting the figures. 230,000. So cash account 230,000. So to 30,000, like that. Then you go to cash account. You cannot open another cash account because you already have a cash account here. So we'll simply say January 4th, purchases account, how much? 230,000. 230,000, like that. Good. So if you already have an account, that's enough. You don't need to have so many accounts. Then bought second-hand motor van for 256,000 paying by check. Bought second-hand motor van for 256,000 paying by check. The two accounts that are affected here are motor van account and bank account. So we'll have to open motor van account and bank account. So come here, we say motor van account, motor van account, motor van account, credit, debit, and then we'll come here and open a bank account, a bank account, bank account. So credit, debit. Now we bought a motor van, bought second-hand motor van for 256,000 paying by check. 256,000 paying by check. And when is this? This is January 5th, motor van. We bought second-hand motor van, 256,000 paying by check, and that one is January 5th. So this money will leave the organization. January 5th, motor van account, 256,000, and then the motor van will gain. This is an asset. So you can see asset is decreasing, asset is increasing. So here, January 5th, we will say bank account, how much? 256,000, because it's gaining. The motor van is an asset, bank is an asset. When assets decrease, we credit. When assets increase, we debit. Just like that. Then paid motor expenses, 12,000 cash. Now, motor expenses are different from motor van. Motor van is an asset, motor expenses are expenses. So it means we open another account, motor expenses account, credit, debit, and they've said this is January 7th and it was paid by cash. So cash, how much? 7,000. Cash account, 7,000. So since we already have cash account, we simply go back to cash account and then post that. Money will come from the cash account, so money is reducing. So January 7th, you say motor expenses, how much? 7,000, like that. So this is credited, it's a credit entry. The other side is a debit entry. Expenses are a debit entry, you can see. Expenses are debit entry. Credit sales, Paris Traders, 24,000. Calvary Group, 26, Finlay, 68. So credit sales, Paris Traders, 24,000, and this is 9th. So sales, we come here, January 9th. Paris Traders, 24,000. how much was it? Sorry. Paris Traders, this is 24,000. So Paris Traders 24,000. And we have Paris Traders? No, we don't have her account. So we'll have to open an account for Paris Traders. So you come here and you open an account for Paris Traders. Paris Traders. So this is credit, that is debit. And then we say, because these are credit, sales Paris becomes a data. So January 9th, sales account 20. How much was that figure? 24,000. 24,000, like that. 24,000. Then we go to the next item. Calvary Group 26,000. Credit sales to Calvary Group 26,000. So we don't have Calvary Group. We don't have Calvary Group. So we'll still January 9th. This is Calvary Group. Calvary Group, and the amount is 26,000. So we'll come here. Since we don't have Calvary Group, we'll open another account for Calvary Group. Calvary Group. Calvary Group account, credit, debit, and then we say January 9 because he is a data, sales account 26,000. Let me just confirm the figure. If we've captured it right, Calvary Group 26,000, yes. Then we have Finlay Limited 68,000. So we again come here, it's the same date. Finlay Limited 68,000. Finlay Limited 68,000, like that. Then we come here. Since Finlay doesn't have an account, we'll open one for him. Finlay account 68,000. So credit and debit. Finlay account. How much? These are data also. So January 9th sales account 68,000. Sorry. Then we come here. Sales account to say January 68,000. We already have it. So 68. Make sure that for every debit there's a credit, and make sure you pass the transactions completely. So that is done. Let's go to purchases. Purchase goods on credit. Johnson Traders. This is 11th. Purchase goods on credit. Johnson Traders. 240,000. 240,000. So purchases, we purchase goods on credit from Johnson, January 11th. So this is Johnson Traders, 240,000. But we already have Johnson Traders, so we simply go back to Johnson Traders account and we update that. So January 11th, we say purchases, account from Johnson. How much? 240,000. We need not to open another account for Johnson when we already have an account for Johnson. So then Da Vinci 62,000. Da Vinci 62,000. So we come back here. I think we also have an account for Da Vinci. Do we have an account for Da Vinci? Da Vinci looks like we don't have an account for Da Vinci. So we'll capture it. So it's our credit sales. So January 11th, Da Vinci account. How much was the figure? The figure is Da Vinci 62,000. So this figure is 62,000. 62,000. So we come here and open a Da Vinci account. We come here and open a Da Vinci account. Open a Da Vinci account. Da Vinci account. So this is credit, this is debit. And because now these are creditors, we will have them. January 11th purchases. The figure was, I think, 62,000. Let me just confirm that figure. It was 62,000. Yeah, the figure is 62,000. You can see this on the debit purchases because stock is increasing, and we credit the Da Vinci because Da Vinci is a creditor. And we said that creditors are liability. So when liabilities increase, we credit. Then purchases returned to Johnson Traders 25,000. Purchases returned to Johnson Traders 25,000. So this has the effect of reducing the purchases. purchases returns to Jonesy Traders. How much? 20. Purchases returned to Jonesy Traders, 25,000. So what we are going to do is we will open what we call the purchases returns account. 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 So debit and credit. Then because these goods, remember purchase is a debit. The debit because goods are coming in. Now we are returning to the supplier, so we are losing the goods. So that will definitely feature on the credit side, and then of course we will debit now the creditor because we are reducing his or her liability. When you want to decrease the liabilities, we debit. So let's get the question again. Sorry, where's the question? This is on 13th. Purchases returned to Jonesy Traders, 25,000. So purchase 13th and then 25,000 Jonesy Traders. So this is January 13th. January 13th. We'll say Jonesy Traders. Jonesy Traders. How much are we talking about? 25,000. So we are returning goods to Jonesy Traders. So these are goods that are leaving the organization. That's why we are crediting, so that we are losing those goods to who? To Jonesy Traders. So remember, Jonesy Traders now, the amount that Jonesy Traders, the amount that will be owing to Jonesy Traders will reduce because we return some of the goods to him or her. So we will simply say returns, purchases, returns, account. And how much is the figure? 25,000. So we are reducing that liability by 25,000. So these are goods we returned to them. So sales returns from Swaju Investments, 11,000. Sales returns from Swaju Investments. So it's almost the same case, the opposite of this. So sales returns will come here and open a sales returns. Sales returns account, credit and debit from Swaju. So when we are returning the sale, remember sales is a credit account, so it will definitely feature this side, so the debit side. So that is January 19th. The amount in question is 11,000 Swaju Investment. So January 19th, 11,000, and we say Swaju Investment. So it's Swaju who returned these goods to us. It's Swaju who returned these goods to us. So we go to January 19th. Let's look for January 19th. What happened? January 19th. Swaju. Yeah, Swaju. January 19th. We say returns, or rather sales returns. Sales returns. Sales returns. How much? 11,000. Like that. Sales returns 11. January 19th, sales returns 11,000. You can see this is the sales returns account, 11,000. This is on the debit side, and then we come to Swaju. Sorry, he was owing us 25,000 because these are data, and now he has returned goods worth 11,000. You can just calculate from here the amount that he owes now is he owes us now is 14,000. That is 25 minus 11. That's how it goes. Then cash drawings by the proprietor, 44,000. Cash drawings by the proprietor. So you simply come here. Cash, we are withdrawing cash. This is 20th by the proprietor for 4,000. So you simply come under cash account because we already have cash account. Just fill it here. So January 20th, drawings by the proprietor. The amount is 44,000. And then we open what we call the drawings account. We open what we call the drawings account. Drawings account, like that. Drawings account, credit, debit, and then these are now money is getting out of the business. So we say January 20th, cash account. How much? 44,000 shillings, like that. You can see it's on the debit side, and we've credited cash to show that money is leaving our cash account. The next thing is payments made to Da Vinci, 62,000 cash. Payment made to Da Vinci, 62,000 cash. So we paid Da Vinci 62,000 in cash. That means money left our cash account. The date is 21st, 62,000 Da Vinci. So January 21st, Da Vinci account, we paid Da Vinci and the amount is 62,000. So we come to Da Vinci account and show that she has received the money. Also, we have credited bank account, so we simply look for Da Vinci. Da Vinci was a creditor, so we paid him, and you can see we were owing him 62,000. So we simply come here and say January 21st, cash account has paid him 62,000. And you can see now this account is already balanced. We were owing him 62,000 and we paid him 62,000 shillings. Received payment from BD Limited, 66,000 through a check. Received payment from BD Limited, 66,000 through a check. So BD Limited paid us 66,000 by check. So we simply go to BD Limited. Let's get the date, sorry. Let's get the date. 23rd. BD Limited paid us 66,000 by check. The two accounts here are BD Limited and check, which is bank, BD Limited and bank account, and the date is 23rd. The amount is 66,000. So we go for BD Limited. Yeah, you can see BD Limited owed us 66,000. Now he has paid us, and this is January 23rd. So bank account 66,000. Our bank account received 66,000. So we show that BD Limited has paid, and then we go to the bank to show that bank has received this amount of money. So where is our bank account? Bank account is here. So we simply say if the bank is receiving, our asset in bank is increasing. So we say BD account 66,000. That is the amount we're going to receive at the bank. And we continue with this journey. Payments made to, no, that one we are done. We are now on 25th. Received payments from Swan Limited, 43,000 through a check. Received payment from Swan Limited, 43,000. That is January 25th. So Swan Limited paid us. Swan Limited paid us. Yeah, received, this is January 25th. So bank, 43,000. I think that's the amount he paid us. Let me just confirm. Swan, 43,000, yeah, through a check. So the bank will receive this money, January 25th, Swan account, 43,000, like that. Good. Then we go to purchases returned to Jonesy Traders, 42,000. Purchases returned to Jonesy Traders, 42,000. Purchases returned to Jonesy Traders. So this is return, purchases returned to Jonesy Traders. Jonesy Traders is creditors because you're talking about purchases. And the date was 28th, 42,000. 28th, 42,000. So 28th, 42,000. So we come here and say January 28th, Jonesy Traders. The amount is 42,000. So let's go to Jonesy Traders. We return these goods. Maybe the goods were not in good shape, or maybe he supplied more than we ordered. So Jonesy Traders, January 28th. Is it January 28th? Let's just confirm. The question is not far from here. Purchases returned to Jonesy Traders, 42,000. So we say purchase returns account. Purchase returns account, 42,000. Hope I'm gotten the figure right. 42,000. Good. Purchase stationery, 4,000, paying by cash. So the two accounts that are going to be affected are stationery and cash. So this is the date is 29th. So capture the date because we already have the cash account. We simply come here January 29th, then say stationery. Money is leaving to go to the stationery account, and the amount is 4,000. Hope I've captured the figures right. 4,000. Good. So I go to stationery account. Do we have a stationery account? No, we don't have a stationery account. So we open a stationery account. Stationery account. So this is credit, this is debit, and then we say stationery is an expense. So we say on January 28th, cash account, the other account that affects this is 4,000 shillings. So stationery of 4,000 was incurred on January 29th, not 28th. So let's just correct that to January 29th. Okay, so we proceed. 30th, credit sells Swaju Investments 42,000, then Calvary Group 54,000. So credit sells Swaju Investments 42,000. So sells Swaju Investments 42,000. Sales to Swaju Investments 42,000. Let's check this one. Swaju Investments 42,000. Sales. Yeah, January. When was that? January 30th. Swaju Investments 42,000. So we say January 30th. Swaju Investment 42,000, like that. Then we go to Swaju Investments. This is January 30th. These are sales. So Swaju is a data, sorry. So January 30th, sales account. How much? 42,000. Then we go to the next party. Calvary Group 54,000. Calvary Group 54,000. Calvary Group 54,000. I'm looking for the sales account here. January 30th. Calvary Group 54,000. Like that. Let me get the figure. Just confirm the figure, 54,000. So we look for Calvary Group because we already have his account. I think that name is not new. It's a familiar name. Yeah, you can see it here. So we simply say January, because it's a sales, is a data. So January 30th, we say sales account 54,000. Good, like that. Then you go pick the next transaction. Oh, they are over. So we are done. Now what we need to do is to close the books. We close the books. So how do we close the books? If it's 950,000, just say on 31st. Do you have 31st? This is 31st January. So we simply come here and say 31st January. 31st January balance carried down is 950,000, and then we'll say January 31st balance brought down is 950,000, like that. So that's how we close. So if we don't have any other figure, we just close like that. Then for this cash account, we'll have to get the totals on the debit side and the credit side. The side with the highest figure will take the day. So by just look at those figures, you can see 950,000 is 950,000 carries the day. That is the high, the huge figure here. You compare the debit and credit side, whichever side has the highest figure will be used as the balancing figure. So this is how you put the balancing figure, 950,000 and 50,000. Then the difference will come here as the balance carried down. So let's get the total. That is 230. 230 plus 7,000 plus 44 plus 62 plus 4. That gives us 347. So 347 minus 950, we get 603. 603,000. So make sure you get the figures right. I hope we are getting these figures also right. Because the moment you mess, you get everything wrong, it will not balance at the end of the day. So then, this is yet another example of this is yet a different scenario. Exactly like as you can see, credit doesn't have anything, so there's no need for leaving space here. Just close, and that's how we go about it. Then you write here January 31st balance carried down. Of course, the total here will be what is missing the other side. So just get the total. This will be 180 plus 230 plus 240 plus 62. That gives you 712,000. So 712,000, 712,000. The side with the highest figure, you can see credit side, you don't have anything. So what is it that is missing for us to get that balancing figure? Is 712,000. Then you come here, you say, sorry, this is not January 31st. This should be the following month. So here we'll be talking about Feb 1st. So here we come here and say Feb 1st, balance brought down how much? 712,000. That should also be the same case here, Feb 1. That is the following month, how the books would look like. Balance brought down is 603,000, like that. So that's how we close the books. So then we come to this is yet a different scenario. You can see this is 240 plus 180, and then this side 42 plus 25. Definitely the credit side has it. So you can see the space. I've left enough space there. So 420 plus 180 plus 240, that should give you 420. That should give you 420. So 420,000. That is the highest figure, 420,000. And of course, this side doesn't add to that. So 42 plus 25, we get 42 plus 25, we get 67. So for minus 420, we have 353. So 353,000, like that, and this becomes our balance carried down, and on January 31st. So we come here and say in Feb 1st, balance brought down how much? 353,000, like that. So that's how we go about that. So that's complete. Then we have this other one, BD Limited. You can see 66,000 and 66,000. So this one is balancing. Just leave it like that. It's balancing. So we are done with that. Then we come to Swan Limited. This side is 11,000. Credit side 11. Debit side is 25 plus 42. This gives us what? 67,000. 67,000. So we'll also have 67,000. These are the sides, 67,000. The difference is 56,000. So we'll say January 31st, balance carried down is 56,000. Then we come here and say Feb 1st, balance brought down is 56,000, like that. So that's how we go about it. That's how we go about it. Then we have Swan. Swan, just put double lines. That will mean it has balance. Then you have the bank account. Of course, we have 256,000 here. This is the highest figure. And this is 256,000. That is what will be used as our balancing figure. Then we have 66 plus 43. That gives us 109 minus 256 gives us 147. So we have 147,000, and this is balance carried down January 31. Then Feb 1st, balance brought down is 147,000, like that. So that's how we go about it. That's how we go about it. That's how we go about it. So then, let's continue. This journey is not an easy one. So 44,000. This is 31st Jan, balance carried down, and so So 44,000 and then 44,000 again, 44,000. Then you say Feb 1st balance brought down 44,000, like that. So it's the same thing here, 11,000, 11,000, like that. Then 11,000. Then we say January 31st balance carried down 11,000, and then we come here Feb 1st balance brought down 11,000, like that. So that one we have closed. This one will be 67,000, 67,000 also this side, 67,000. Then we say January 31st balance carried down 67,000, and then we say Feb 1st January balance brought down how much? 67,000, like that. Come to stationery, close it. Sorry. So close the stationery, 4,000. This side also 4,000. So balance 31st January, balance carried down 4,000. And then Feb 1st, balance brought down 4,000, like that. Then you go the next one. This one, it has balance, so we just close it like that. So we are done with that one. Then here we'll come to, we'll have 68,000. Then 68,000 also this other side. Then January 31st balance carried down 68,000. Then Feb 1st balance brought down 68,000. So we've closed that one. We go to the next one. This one we have already closed, so we come back here. This is 26,000 and 54,000. That will give us 80,000. So 80,000 also here. Then January 31st balance carried down is 80,000, and then we say Feb 1st balance brought down 80,000, like that. So we are moving on where? So we have Paris Traders. So this is 24,000. January 31st balance carried down 24,000. And then January, the best way to close is actually just let's have 24,000. 24,000 also here. 24,000, like that. And then you say Feb 1st balance brought down 24,000, like that. So here we'll also have 7,000 as a balancing figure, 7,000 as a balancing figure. Then balance carried down January 31st, balance carried down 7,000. Then Feb 1st, balance brought down 7,000. Like that. Hope you are now understanding. You now know how to close these books. It's not a very complex task. 256,000. Might be tiresome, but it's not that complex. So 256,000, 256,000. And then this one we say January 31st balance carried down. Feb 1st balance brought down 256,000, like that. Yep. So I think this is the only one that we are remaining with. So just like others, we'll have a balancing figure here. Get the total 66 plus 25 plus 43 plus 24 plus 26 plus 68 plus 42 plus 54. That gives us 348. So 348,000 348,000. Then we come here, January 31st, balance carried down 348,000. Sorry, 348,000. And then we come here and say Feb 1st, balance brought down 348,000, like that. So you have to make sure that you are very keen, because if our trial balance, because we are going to pull a trial balance, and if it doesn't balance, it means that we have made some mistake somewhere. So we are done with the first part. This is question 1B1. We should be able to get 12 marks. And I believe this should be 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 19 ledgers. So possibly for the examiner might give you like, depends. But generally a ledger should give you 1 mark, but you can see these are 19 and marks allocated is 12. So if you are right, you will just be given. The whole thing is that we mark transactions. So just make sure you get the transactions right. And then of course, if the final figure is balancing well, that gives you more marks. So let's go to the second part, and the second part is the trial balance as at January 31st. So we'll come here and say, now it's good manners always to start with the title, and it's actually expected like so. So Cecilia Atieno, Cecilia Atieno. So Celia Atieno, trial balance. We'll come here and say Celia Atieno, like that. Trial balance as at 31st January 2021, like that. So with that, we go straight debit and credit. Then of course we have shillings. We also have shillings this side, like that. So we'll be picking these things as we move. So we start with capital. Capital, you can see, once you are done, we'll just tick capital. Now we pick these figures as they are. Now you can see this is 950,000 on the credit side, so we pick it as it is. The balance brought down, that's what we are interested in. So it's on the credit side, that's how we'll pick it. So capital 950,000 credit side. Capital 950,000 credit side. So simply come here and say capital 950,000 on the credit side. We just read, we follow the instructions as they are. So we are done with that first part. Second part is cash account. Cash account 603,000 on the debit side. Cash account 603,000 on the debit side. So we come here, we say cash 603,000 on the debit side. Like just like that. And then, so we are done with this. We'll give ourselves a tick here to show that we have already done. We are done with that. Then we go to purchases. Purchases is a purchases account 712,000 on the debit side. Purchases 712,000 on the debit side. So we come here, purchases 712,000 on the debit side. Sorry for that. 712,000 on the debit side. Good. The next, so purchases, we are done. We will just give ourselves a tick to show that we are done with that. Sales 348,000 on the credit side. This is the figure I'm talking about. Sales 348,000 on the credit side. Sales 348,000 on the credit side. So sales 348,000 on the credit side. Then we go back. So we are done with the sales account. Now let's go to motor van account. Motor van 256,000 on the debit side. Motor van 256,000 on the debit side. So motor van 256,000 on the debit side, like that. So we are done with the motor van. Let's just give ourselves a tick to show that we are done. Motor expense 7,000 on the debit side. Motor expense 7,000 on the debit side. So we come here. Motor expense 7,000 on the debit side. Motor expense 7,000 on the debit side. Then next, Dance Traders Calvary Group. This is Da Vinci. I think let's leave these people first. We'll come back to them because they're either creditors or debtors. So once we identify, we'll just put them together. So stationery 4,000 on the debit side. So stationery 4,000 on the debit side. Stationery 4,000 on the debit side. Like that. So we are done with stationery. We have already given ourselves a tick for that. Then let's pick from here. Drawings for 4,000 on the debit side. Drawings for 4,000 on the debit side. So drawings for 4,000 on the debit side. Then sales returns 11,000 on the debit side. Sales returns 11,000 on the debit side. So sales returns 11,000 on the debit side. Sales returns 11,000 on the debit side. Don't worry about the frequency so long as you are doing the right thing, no problem. Purchase returns. Purchase returns. Now we are picking purchase returns. This is 67,000 on the credit side. Purchase returns 67,000 on the credit side. Purchase returns 67,000 on the credit side. Next, Finlay, let's leave that one. Bank, this is a straightforward case. So bank 147,000 on the credit side. 147,000 on the credit side. Bank 147,000 on the credit side, and that means that this is an overdraft. Bank 147,000 on the credit side, because general bank is supposed to be on the asset side, but in this case it means it's we spent more than we had in the bank. It's okay. So Swan, Saju, BD, Jonesy, I think we are done. Now we are remaining with two parties here, and the parties are either accounts receivable or accounts payable. So under accounts receivable, we will have, let's just have accounts receivable. Now these are the debtors. So let's look for those with the debit balance. So for Davidson, Da Vinci, nothing. You can see it the account balance. So that one, there's nothing. Calvary Group. Who was Calvary Group? Calvary Group was a debtor. So accounts receivable, we have debtor here with a debit balance of 80,000. Calvary Group 80,000 debit. Calvary Group 80,000. Calvary 80,000 debit. That means he's a debtor. A debtor is an asset to the organization. So we are done with Calvary. Then there's this Paris Traders. Paris Traders is also a debtor. How do you know that? You just look at whether it's debit or credit. You can see the transaction was on the debit side. So balance brought down 24,000. So 24,000 on the debit side. Paris Traders 24,000 on the debit side. Paris Traders 24,000 on the debit side. So Paris Traders 24,000 on the debit side, like that. Good. So we are done with Paris. We need to give this a tick. So I think we are done with the whole of that side. Yeah. Now let's come back to this side, and we are just identifying the debtors. So Jonesy account. Jonesy account is this is a credit account. You can see the transactions are on the credit side. Then BD, his account balanced. So this one we have nothing, it's complete. Swaju Limited. Swaju is a debtor. Their accounts are on the, you can see transactions are on the debit side. So we have 56,000 on the debit side. So Swaju 56,000 on the debit side. So we come here, Swaju 56,000 on the debit side. Then we now move to, we're almost done. So we are moving to Swan Limited. This, you can see the account has balance. So we are done with this, and we're also done with Swaju. So let's continue. Finlay. Who is Finlay? Finlay is a debtor. You can see the transaction is on the debit side. Balance are on the debit side. So Finlay account 68,000 on the debit side. So Finlay account 68,000 on the debit side. Finlay account 68,000 on the debit side. Then we have, so we are done with this. Then we have purchase returns. I think all those we are done with that. So then we go to accounts payable. Accounts payable are the creditors. Accounts payable, and this is our last transaction here. Account payable. Now, account payable, we have, I'm trying to look for the ones that we have not marked. All these we have marked. All those we have marked so far. We have marked. We have marked. We have marked. I think it's only John C. Yeah, it's only John C. So John C here. John C, the accounts are on the credit side, so this is purely a creditor. Balance brought down is 353,000 on the credit side. So John C, 353,000 credit side. John C, 353,000 on the credit side. So John C, 353,000 on the credit side. 353,000 on the credit side. Do we have any other one? I doubt. So let's just check to confirm that we've captured everything. So capital, we have captured. Cash, we've captured. Purchases, we've captured. Jonesy, we've just captured. BD, sales, Swaju, Swan. I think all of them we are seeing ticks. All of them have ticks. And those ticks mean that we have captured. So I think we have exhausted all of them. So what we need to do is to get the totals. We need to get the totals here and the totals here. Now, these totals, something about them is that they should agree. Remember, everything that we are posting on the debit side, we are also posting on the credit side. So they must agree. And if they don't, it means somewhere we possibly might have done something wrong. And that's one of the uses of the trial balance. It's used to detect errors. So 1865 like that, and this automatically means that the other side should also, the debit side should also be 1865,000. So let's check if that is the case. 603 plus 712 plus 256 plus 7,000 plus 4. In case it doesn't balance, don't get worried, especially in an exam setup, because we mark the entries. We mark the entries: plus 24 plus 56 plus 68. That gives us 1865. Good. It has balance. So it means we've been very much correct. So the trial balance should automatically balance, because everything you are putting on the debit side, you're also putting on the credit side. And that's how it's supposed to be. So with that, thank you. We are done. Let's meet in the next question. Share, subscribe for more.